Hello and welcome back to the channel Implied Investing. Today we're going to be doing a quick video on ETFs and their generations. So all ETFs are not created equal. But before we get into that, let me get all the legal disclaimers out of the way. I am not an investment professional. This is not investment advice. It is for entertainment and education purposes only. Before making any financial decisions, please consult an investment professional. All right, back to the topic. So the ETFs, as we know them, they came in generations. Before 1950s, 1960s, 1970s, people used to buy a basket of individual stocks and hoped everything worked out. And during their retirement, they would use that for some income, but a lot of people had pensions, so they didn't pensions and Social Security, so they didn't depend on it as heavily. But starting in the 90s, ETF investing became the thing. Well, it became a thing to do. And ETFs back in those days would just track an index. They would just pick an index like the S&P 500 and follow it. They would pick the Dow Jones Industrial Average and they would follow it. Or they'll pick the Russell 2000 or they'll pick the NASDAQ and they would just follow this index. And that's what the early ETFs did. These were extremely low cost uh, products, easy to access, and they had the advantage of they had advantages over a mutual fund in that you could sell them at any time that you wanted. Mutual funds, you have to wait to the end of the trading day to close out. And right here we have those exact ETFs. VOO represents the S&P 500, DIA represents the Dow Jones Industrial Average, IWM represents the Russell 2000, and QQQ is the Nasdaq. These ETFs did not have a lot of jazz going on, but they've proven their worth. They stood the test of time. Almost everybody portfolio has a little bit of the S&P 500, has a little bit of the Nasdaq. And if you bought these things, they stood the test of time and they really performed quite well. Over the past 10 years, the S&P 500 is up 300 and almost 40%. The real outstanding of these four are the Qs, the Nasdaq. It's up almost 570%. So there's nothing wrong with the earlier generation ETFs. They're not broken. It's just that people wanted to try to optimize for certain targets, and that brings us to our next generation of ETFs. The next generation of ETFs happened in the early to mid 2000s. These are what you call sector ETFs. XLK, XLF, XLE, representing the technology sector, the financial sector, and the energy sector. So if you wanted to get direct exposure to what was hot, so for people who were adults in the uh, early mid 2000s, you all know that energy was hot. Gas prices were high. And if you wanted direct access to the energy sector, you would go and buy the XLE, and it would give you that direct access to it. Over time, these ETFs have done okay, some better than others, as you can see, because technology is so hot, it's at almost 650 points. Energy, not so much anymore. Financials, they all have, every dog has its day, but once upon a time, these things were the way to go. These were the targeted sector ETFs, and this is the early to mid 2000s. And then the mid 2000s to 2010, you have another switch, and that brings us to factor investing. Factor investing is really kind of generation two. This is the what I would call generation two ETFs. The first one was generation one. The sector investing is generation 1.5. The factor investing I call generation two. And factor investing decided that, hey, we can use the different factors that we see in stocks in order to pick ETFs, not stocks, to pick ETFs and put some rules around it and get some pretty decent returns. And you'll see everybody's darling in here, SCHD. SCHD is a factor ETF. It's dividend and quality. So they screen out their universe of stocks for dividend and quality. You have RSP, which is an equal weight version of the S&P 500. It's factoring in weights and sectors. VTV factors value and growth. And then you have SPMO, which uses the momentum factor. These ETFs are very popular. I don't think people really use them as the core of a portfolio, but they are a nice satellite or a nice complement. SCHD is used as a defensive hedge. SPMO is used as a kind of growth factor. If you have FOMO, SPMO is the ETF for you because it's going to it's going to make sure that you're inside of all the hot stocks. So if a stock has momentum, you're going to be there with it. So that's generation two. And then I'd say we're currently in generation 2.5, 2.3. I mean, 2.5 or generation three. Early 2 point, we're in late 2.5 or 3. So this is the generation of your JEPIs, of your QYLDs, of your DEVOs, and of your NUSIs. So I'll go down and explain a little bit about each one of them. So QYLD is just a straight up covered call. They are writing over almost 100% of the portfolio and generating that income for you. There's not a lot of strategy there. It's tracking its index and it's writing covered calls and paying you that income. And then um you get ETFs like Devo from 2016. So QYLD came out in 2013, and then you get Devo that comes out in 2016, and it's tactically writing covered calls. It's saying, hey, this stock is showing some momentum, so let's not write over it. Let's not write over the whole portfolio. Let's write over these two that are losing momentum or they're trending downwards. Let's start selling covered calls on that. And Devo has been wildly popular with this strategy. As you can see, it allows for price appreciation when you tactically write those covered calls versus QYLD, which is just a systematic writer of covered calls. Moving on to NUSI. NUSI is a protective collar. So this is the idea that you're going to buy a put option and you're going to sell a call option. And what this does is that while you're giving up some of you're giving up, you're capping your upside maybe at 9%, but perhaps at 10%, depending on where they place the collar, you are getting protection, meaning that the stock price, if it goes down, if we have a crash, you're very well protected. You have to time these ETFs pretty well. You want to get in when they say get in because they make these options. I mean, I'm sorry, they make this ETF out of options, and options have different expiration dates. Thusly, when you buy in, let's say half the year is gone and the market's up 5%, well, you're only getting an additional 5% if your call option is written at 10% above market price. You're only getting an additional 5, and then you're capped out. But you still have that downside protection. So it's very important with ETFs like that you buy in when they start at their start date. And lastly, JEPI, everybody's favorite. JEPI is the king, is hands down the cover call ETF with the most assets under management. I think they're like 30 billion or something like that, although they are seeing significant outflows. But JEPI writes its covered calls. It uses ELNs in order to do it. These are equity linked notes. And they pay out a very good distribution and they have modest, very, very modest price appreciation. And you can see that in the chart. It doesn't show so well in the 1 year chart, but the 3 year chart, you can see the modest price appreciation, but it's not collapsing. It's nowhere near Devo. It's not as tactical as Devo, but it is something. So you got 5.87% price appreciation, which is decent, and it was what's available. But then the next generation of ETFs roll around. And hang on, before I move on, I want to say that not all of these ETFs are created equal. I may put Neos on. I didn't really know where to put Neos's products on here, but they came about, and they're basically JEPI, but they allow for price appreciation and they're tax efficient. So I would say that they're like if we're in generation 2.5, their ETFs are like a generation 2.7, something like that. They're probably a generation 2.7 because they're tax efficient, they have price appreciation, and they have higher yields. It may just be a skill thing, or maybe they care more thing. I don't know. JP Morgan's a huge company. I'm sure this JEPI is a good portion of their revenue, but their customers aren't leaving, so they have enough customers who like the product, so they're not changing it too much. But moving on to Generation 3. Generation 3 ETFs are probably the ETFs that I'm most excited about. As you see, I have it on the 6 month chart, but I really probably should put it on the 1 month chart. And even that is too much, is because these products have not been out very long. Most of these, I'd say Generation 3 started in 2020, maybe 2022, maybe 2023, but it is in full swing. You are getting so much more with this generation of ETFs than you got with previous generation of ETFs. So here on with this generation of ETFs, you get Wheel, a ETF like Wheel. Wheel runs the Wheel option strategy, and that's selling put options, right? When this and you're just collecting that income when the price of those option, I mean, when the price of the stock goes down enough, you get assigned, and then you immediately sell call options on it. It's a very lucrative strategy, but it does cost a lot of money because options, as you know, are sold in baskets of 100. So if you're trying to do that on the S&P or the Nasdaq, for VOO or QQQM, you're looking at $60,000. If you don't have $60,000 to run your own wheel, they'll run it for you. And then we have ETFs like BLOX. BLOX runs what I think is going to be one of the more popular strategies where the portfolio construction is half ETFs, half stocks. They run covered calls on the ETFs and they run put credit spreads on the individual stocks. It is a very interesting strategy. Blocks does it on crypto related things, but they have another ETF GIAX and they do that on, more traditional equities, but it is both calls and puts at the same time. And then you have ETFs like Mago. Mago came out December 30th, I want to say, and it has the Mag 7 ETFs, but instead of running a covered call strategy, it runs a put credit spread strategy to generate the income. And the benefit of that is that there's no capped upside. So if the mags take off, if Amazon, if Google, if Nvidia, if Tesla, if Microsoft go on a tear or come out with some new AI chip that's just incredible, then you get all of that price appreciation and your income is coming from the put credit spreads. So this is what I would call Generation 3 ETFs. And I think that Oh, SPY H is it's almost like a defined outcome ETF, but instead of just giving you that downside protection, they're selling covered calls on top to generate current income. It's not going to be as high as like a SPY I or something like that, but it'll give you like 7%, I think is what they say on the website. But all of these ETFs have very sophisticated option strategies that just previously were not available to us retail investors. And I think that as the market demands different things from these ETF providers, I think we're going to get them. It has never been a better time to be an ETF investor. So just to do a quick recap, over the generations of ETFs, you have your generation one ETFs, they just follow an index. You have your generation two, they give you generation 1.5, they give you specific sector exposure. You have your generation two ETFs, they use factor investing. This is your SPMO, momentum factor, SCHD, value dividend factor. These give you your factor exposure. Generation 2.5 is your covered calls. These all use different strategies of covered calls to generate their income while following an index. And generation Three is covered calls plus put credit spreads. It's taking both sides of the option chain and working on them. And really, MAGA under that definition, MAGA shouldn't be here because it uses put put credit spreads only. It doesn't use covered calls. But previous generations, you would have never seen a put credit spread ETF that generates it. I think there was one called OVL, but it's so small and it really doesn't perform that well yet. I mean, they may change their strategy. So that's my review on the generations of ETFs. I hope it's been informative. I hope that you guys learned something. Please like, subscribe, and leave a comment. Let me know what generation ETFs you mostly stick with and what ETFs you're thinking about adding and what generation they're from. If you like this type of content, please give me a like and please leave what type of reviews you'd like to see in the future for future videos. Thank you and God bless.